Welcome to the Wealth Rebel Show. I'm your host, Emma Wright, the resident Wealth Rebel here on YouTube and on podcast. Today, I am super excited to be introducing to you, as part of the Investment for Good pillar, a regular feature of the show, a regular expert of the show, a friend of mine, and a beautiful soul, that is Adam Brewer. Welcome, Adam, to the show.
Hi everyone. Hi Emma. You okay?
We've got a little bit of a gap between us today, so if there is a little bit of a pause, that's okay because we can catch up and really hear what each other is saying, and that's super important. And that is the tech of the world, right? So, firstly, I just want to introduce you to this wonderful human and why we are so blessed to have him here, which, by the way, is going to be a regular feature. Adam is going to give up his time every quarter to come and sprinkle some investment magic into your lives. AKA, meaning he also sprinkles it into mine, may I add, which is one of the huge benefits of doing this show, that I get to, interview people like Adam. Every time I speak to Adam, my life infinitely is more wealthy, whether that is from a profound insight into something that I didn't even consider when I speak to Adam about the financial markets or investing. And I think, I know a lot about investing. I speak to Adam and I'm like, I always feel my knowledge is expanding, and that is what it's all about. But also for my life, right? Adam's energy and passion for what he does is just so incredibly infectious. And that is what I want you to really embody from this regular feature and from Adam's energy, is to feel that investing is for you and to get that infectious feeling so that you can go on and be really empowered by it. So I just want to firstly just kind of tell you a little bit about how Adam came into my world. So I met Adam towards the end of my corporate wealth career in 2019. After I'd had baby Harry, my whole life had changed. And at the time, we had like a shared client. We were technically competitors. This client would work independently with Adam over here in the investment world, and then separately with me as a chartered financial planner. And, some of your listeners will be thinking, and this is one of the things that I think is really important to understand, and it is something that we can talk about in a future chat, is what's the difference? This is something we can dive into, the different roles that people can play in the investment and wealth industry. This knowledge and all of the knowledge that we plan to share with you in little snippets is really powerful, because it helps you to understand and it helps you to get the best advice or expert when you need it. Knowledge really is powerful. When I left the wealth industry, and this is kind of where Adam and our relationship blossomed from, really, is that we had this massive respect for each other, despite technically being competitors. And we came together, and Adam was one of the first people that supported my new venture as a coach. He came into my first mastermind, the Wealth Society, remember that? And this incredible human helped me to relaunch myself. And as I now relaunch myself again this year into a different energy and to a different show, it just felt like the most kind of sensible thing to do, to get Adam to come and bring his wisdom in and to up level, as we all up level in this world. So it's just really exciting to have you here. I just want to touch on some areas that Adam and I are going to touch on in this regular feature. So, and this has come from Adam. Adam likes to do his homework. He loves to kind of be prepared. He's more organized than me, which is amazing, and it is a breath of fresh air for the show. We want to touch on investment fundamentals, like, what's a collective? What is, why would you use a fund or a collective versus direct investing, like shares, bonds? We will get into some of those technicalities in future episodes. What makes a good investment? What is it, even the meaning of investing? Why invest in the first place? What is compounding? Easy wins. Yes, easy wins for investing. And it isn't what you think. This is going to be a game changer for you. And that is why I'm really proud that we have Adam here to actually tell the truth of investing. behavioral impacts that make markets and, markets move, the impacts that they will have on your own mindset as an investor. All of these things, will really enhance how you experience investing. Common misconceptions. Adam has promised some harsh truths, and I can't wait. Amen. Honesty with investing is the only way that you will build confidence, because it's trustworthy. You trust yourself, and that's really, really important. And then we'll dive into things like ESG, impact investing, sustainable, SDGs. And I don't even know what an SDG is, aka that is why we want to kind of bring these things up so that you can really understand what it is that's being said to you. If you sit down with a financial advisor or you're reading something, knowledge is power. And we're going to have super amazing conversations about investment wrappers, like the accounts that you open up your investments. So basically, Adam's got it covered. I'm just going to kind of be here and chat along. No, we've got it covered. We can't wait to kind of go on this journey with you. And what I want to add is that every quarter, starting from November, Adam is a guest expert in the Star Portals Investment Circle, and he's going to be coming live in our private Zoom room with the members so that he can sprinkle that magic into that space. Now, the Star Portal is £8 a month. It's a community. It does have learning online, but Adam is going to give you market updates and help you to really support you on your investment journey. So if you do want to come in, you can use the code STAR1month. Look up at the about section and go to the links in my about section for that link. It'll give you 1 month's free. So don't wait to come in to our world. We are here for it. So, Adam, that's the introduction. Don't worry, every time we have these quarterly meetings, we don't need to have all of that, because we can go, let's go back and listen to that podcast where we kind of tell you what we're going to be doing. This is the first of this amazing feature, and it would be super great for you to share about who you are, because people know me. Tell me a little bit about your journey to becoming an investment manager. How did it all start for you, my love?
Amazing, amazing. You make me blush. All right, with
That's the
all of
point.
that. Thank you very much. Very, very nice. Um, yeah. So I think my path was kind of set anyway, and I didn't know it, and no one really knows it. But the where I've ended up seems to fit me very well, out of maybe pure coincidence or out of blind luck. Um, and I kind of put everything down to, and it's going to sound odd, laziness to a point. So now bear with me. When I was at A levels, you had to choose your A levels, as everyone do, and I chose maths, physics, tech, and biology. And the reason I picked maths and physics was because you just had to write a number in a box. That's all you had to do. Work it out, put a number in a box. Whereas history, you have to write huge amounts of writing, huge amounts of stuff and exams and essays and things like that. And it just seemed a lot of work. So I went for the easy thing. So you can put that down to laziness. That pushed me then into physics at a degree. Then I moved over to economics as a master's, and then everyone knows physics students and economics tend to go into banking, accountancy, or wealth management, asset management. So after a bit of traveling, as everyone does, I went to London and worked for a few sort of asset managers and hedge funds, and worked with a lot of the background data and modeling and things like that. And whereas you back test a strategy, you think, right, this will work. You back test it throughout time. Would it have worked in the past? Yes. You implement it, and then does it work in reality? No, it doesn't. So I did that for a few years, but I'm a Devon boy anyway. I grew up in a little fishing village called Beer on the south coast, and always wanted to come back. So 2010 came back, started at a discretionary fund manager, which is sort of the wealth side. So it's partly client facing, partly investment as well. So that's where I am now with different guises. Yeah.
Ah, Adam, you've said some amazing nuggets here for me, because we nearly like mirror each other literally in our paths. Like, I did maths and biology, and I did maths partly because I was being lazy. it wasn't really the thing in the box that did it for me. It was because I was naturally just really loved it actually, and I loved formulas, and it was like, you either can work it out or you can't. I liked that. I liked the power of the numbers. So I kind of like really resonate with what you said. What's super interesting? This is interesting. I feel like we've got a bit of a difference with our north-south divide. Let's get a little bit of banter going here because you grew up in the south. You grew up as a Devon boy. I'm now a Devon girl, right? Because I've like moved down here, but I didn't go traveling as everyone did. And I think, I just want to kind of say, I think sometimes where you grow up and the people that you surround yourself with can really influence the way that you go on to live and the way that you go on to experience life. Because I didn't go traveling. I came from a completely different background where I had to get out. I went to Manchester and then I kind of had a really similar approach into wealth management as well. Really, really similar to you, came down to London and then came back down to, didn't come back to Bradford, came to Devon, but obviously realized like the south was a little bit more balmy. But it's just so interesting to see that we have this conception that traveling as everyone does, right? Wasn't the case for me. And I do think that is why when we can create these conversations and we can create a collective in a space and we can meet people like when I meet you and you meet me and we share these things, it's knowing that these options are out there that you can go traveling and you don't have to dive straight in, a little bit like the markets, right?
Yeah, that's right. I mean, I think one thing we've got in common is it was the water for me. That sounds strange, but being away from water was just didn't fill me with it made me claustrophobic. And my last year in London, I lived in Canary Wharf, which really helped being right next to the water. But I've got to come back to my coastal village, and that's it really. So that was a big drive for me as well.
Yeah, we definitely have a love of the ocean, right? And that water element and kind of that connection to nature is so important. Oh, Adam, I think we've got more than just water in common, but it's definitely a major anchor for us, And one of the things that when we are investing is having an anchor. It's super, super important to anchor into why we're doing these things. Now, you kind of obviously gave me a little bit of like a segue into kind of some of those topics you want to talk about. And the thing that peaked out for me in curiosity, I was like, I need to know more. I just need to know more. What is the meaning for investing for you? Okay, when you think of investing, what is investing when you kind of like break it down for Adam?
Yeah, yeah. You could take this many different ways, and I think there's two levels here. The first level is the meaning around investing. Why is that person, or why are you investing? There has to be a goal, an objective, or somewhere to get to of why you're doing that. I think that's one level. That's a very high level, and we can go into more detail about that sort of objectives. Um, the other point is the meaning behind investing is what are you investing in? And so if you're investing in a company, if you're investing in a certain theme of investing, why are you doing that? And does that does that resonate with you behind this meaning? So there's two different things, two different levels here. Um, I think if we just start off, I want to sort of rewind and we said I want to keep this very simple for everyone and just boil everything down to these simple, not quite black and white, but very easily understandable concepts, and we can put some reality around it, I think. And so before anyone starts investing, you've got to go back to these three things, which are fairly um, I'm going to say boring. I'm going to say boring, and because everyone wants to get to, I want to invest. I want to invest. I want to make money. I want to invest in this. I want to invest in that. The next new hot thing going on, or fad, or trend, or something like that. It's not that. It's actually step back a bit and think about why you're doing it, the meaning behind it. And these three things, and you'll remember this, Emma. But these three things are very important just to think about. And the first thing is that why, your objectives. What are you trying to achieve by investing? Um, when do you need the money? Is it for a property? Is it for a safety net? Is it for retirement? Is it for children, grandchildren? Is it for a rainy day fund? There's a huge amount of different reasons why someone needs to invest. Is it because you want to buy a yacht in 10 years' time? And you can put timeframes to it as well. So objectives as I want it at this point, at this point, at this point. And a lot of people investing, for me, investing is never has a cliff edge. It never really has a I need to invest for 10 years because of this. There's rarely this thing. People invest and they understand it, they get used to it, they understand the characteristics and nature of the market, and then this investing theme and that education rolls on the whole of their lives, and hopefully they pass that on to the children, their children's children. But these objectives are, maintaining my standard of living. Objectives: I want to travel more. I want to invest because I want to work part time. There's a lot of different things. So think about what you need, what you want. That's the first thing. That's a bit of detail, but that's the first thing, really. Objectives. Now, the second thing is getting a little bit more technical, and it's what we call in the industry capacity for loss, which is actually your ability to take risk. And the word ability is very important there. Um, how are your what are your financials looking like? Can you afford to invest and have your money and savings be slightly more volatile than cash, slightly more uncertain, but we can talk about that, than cash? If they do fall temporarily, will it impact your standard of living, your objectives that you want to live by? Will it impact your ability to put food on the table and heat your house? There's a lot of these things. Run your car. So capacity for loss, the second thing, is quite important. That's very sort of black and white. Your ability to take risk. And the third thing I like to look at is this thing called attitude to risk, which, Emma, you'll recognize these. The attitude to risk is not like having a good or bad attitude with anything. It's your risk tolerance. It's how your emotional connection to investments. So how much can you sleep at night, basically, knowing that your investments are going up and down daily, which they do. Investing in, I'm talking about more shares, equity investing, things like that. But also your property does, but without you knowing, obviously. We can talk about that as well. So your attitude to risk is really your emotional response to volatility. So that's your willingness to take risk. So your capacity for loss is your ability to take risk, and your attitude to risk is your willingness to take risk. Do you want to take this risk, and can you cope with it? And that also stems into not making behavioral mistakes when the market is throwing up something for you. So a lot of things happen every single day. There's a lot of worries. They say the market climbs a wall of worry. The market goes up with all these things happening, and it continues to go up. But there's a lot of things to always say, you should sell now, you should sell now, sell now. And people tend to want to sell when the market is low and they've lost some money, because they just want to stop the pain. And we can talk about that. I mean, that's talking really about, have you ever been on a station and your train's delayed, and they say your train is delayed, and they don't tell you how long it's delayed for? They don't tell you, is it 5 minutes? Is it 2 hours? Is it just cancelled? You don't know. It's just delayed, and you just want to stop the pain. So
Yeah,
you
you
want to
just
know.
left
You want to
kind of
know.
wondering. You just reminded me of a recent story. I'll quickly share it. I was on a flight to Portugal and we were in Lisbon, and they just weren't telling us what was happening. And I was more in fear actually because I didn't know. We ended up flying all the way down to Faro, and I was like, just tell me what's going on. It's the fear of the unknown with investing is profound. What you've just described, those three steps, right, is for me, is life, right? And this is the thing. When you come at it from a different angle, because the words that you've used, objectives, capacity for loss, ATR, attitude for risk, is very much investment talk, right? And I love that. And this is why it's great to have you on here, because I'm in a different world now. I'm not in that world like the way that I am all the time, which is why I love to touch in with you and hear what's going on, because it keeps me grounded. But fundamentally, how you approach investing is how you should approach everything in life. And, this is what it brings up for me, Adam, is your why. Why are you doing anything in life? Okay, having that why, because we need to know why we're doing it, why we're setting up a business. Because when you set up a business, you're setting it up for yourself. When you invest into an existing business, why are you doing it? You've always got to have that purpose, that intention, and that timeline, even, of when do you want to see the fruits of your labor, whether someone else is doing it for you, if you invest into take Apple, or whether you do it in your own business, or whether you do it in a relationship, or whether you do it in a home, whatever asset you are putting that energy into, time, energy, and money into, then that number two, capacity for loss, the ability to take risk really comes from that deeper level of understanding. And this is why we need to kind of build up our confidence to do things now, to drip it in. And we're going to talk a little bit about this today, aren't we? We're going to go deeper, because the more that we realize that if we don't start just dripping money in or building things up, we do have a big impact. And I was thinking, even if you started with £25 a month into your pension or your stocks and shares ISA, that's your monthly coffee. You ain't gonna miss it, right? You have capacity for loss. We have capacity for loss when we're accumulating wealth, and we really need to kind of understand more about that. It's when we build, and this is one of the common misconceptions, is that I need to have built up the money and then invest. Well, that's when you're going to have more of an attachment, a feeling, an attitude to risk, a scarediness of investing, because that if you have 10,000 going in, you are more attached to that 10,000 than if you'd have been dripping it in over time. So this is why these are so beautiful, because it really kind of raises the awareness of the flow. But the feelings aspect, that final pillar, that number three, that attitude to risk, is avoidance of pain, isn't it? Like for me, what came up as you were talking, the way that we feel and that avoidance of pain is that behavioural. It leads to those behavioural risks. And nobody wants to be awake at night worrying that their investment portfolio is all over the place. And that's why when we're building up these pots and these wealth pots, we have those clear objectives. We know what each part is for. We haven't got necessarily a negative attachment to it. We have that kind of abundance mindset, and we can see things with that big clear picture. And I really believe two things, and this comes back to what you kind of said at the start, is that investing is simple. We love to overcomplicate things with jargon and make things hard, because how does the wealth industry make its money? Because it makes its money from doing it for you. The more that you can get comfortable with things, you can get the right advice in the right areas. And investing is so simple, and it'd probably make your life a lot easier, Adam, if people really did realize the simple methods that we can take to invest in, because then you could get on with it without having to deal with people having a worry when markets are crashing and telling you to sell at the wrong time because they have that weird attachment. And it is real. It's so real. It's bringing that reality into it. So thank you for sharing those three steps, because for me, it's like I kind of come at it now from a much more different brain, if you like, because I see things, especially when you run your own business, and you're obviously kind of, when you run your own business, you become a little bit different in the terms of risk. You feel differently about risk, and especially when you've traded risk, it kind of does give you that little bit more of a roller coaster vibe going on. But it's helping people to realize that actually we're not on a roller coaster. It might look like we are, but we aren't. We aren't on the roller coaster. We're very actually quite chilled on our paddleboard, right? And that water, because we have got all of the things set up in the right way for ourselves. So I love that, Adam. Thank you so much for bringing some of your wisdom to kind of get me thinking again and get me scratching my head when it comes to investing. What's super interesting is that like the meaning behind investing for me is and I do love to kind of give my take on things as well. The meaning for investing for me is to hold assets over time that can grow in value in real terms. Because I always think, how does the wealthy get wealthy? They get wealthier because they own assets that over time can grow in value and, you know, sadly
I've got an
cash.
example actually
Yeah.
of that, and I did write something down before, and I just and I'll just share it with you because I think it's quite interesting, and you can check my math on it. Okay, but I did write it down, and I've got this scenario I was going through, and I titled it. It's on my phone. I titled it "Why the Rich Get Richer." So it's a story about that, I suppose, wealth inequality and what side you want to be on. But it's also a story about compounding, and it's also a story about what you mentioned before is just adding a little bit into your pension contributions each time, just small amounts here and there, and it adds up. And so we'll see what you think of it. But and again, check my maths. Um, so I made this up. So there are two twin brothers. Okay, they live absolutely identical lives. They both start working at 18. So one earns a minimum wage of £11.44, okay, and the second earns £1.43 per hour more, and that's £12.87. So you could think about that. The second one earns a little bit more because he starts working 52 minutes a day earlier each day. It's about £50 a week. Okay, so one on earns slightly more. The total expenditure, because they live identical lives, the total expenditure matches exactly the first twins' earnings. So that's about just under 21,000 a year. And that's 5 days a week, no holiday, just to make the maths easy. They both spend the same amount of money. Now, they both get, if you're following, they both get pay rises of about 4% a year. Okay. And that just matches inflation. So you can think about they get pay rises, but they're spending it because food's more expensive, living's more expensive, the way they want to live is more expensive, but they're exactly the same. Okay. Now, the second one still earns at the beginning a little bit more, and it'll start earning more than that, the first brother. So the second decides to put his excess earnings each month into a savings account. And the average stock market return over history is about 10.4% per annum. Okay. 10.4%, that's taken mostly the US stock market over a long period of time. We can put that higher or lower. So they both work 50 years. Okay. It's a hard life. They work 50 years. They both retire at 68. Okay. The first brother obviously has zero savings because any pay rise he's had is matched inflation. He's spent it. So zero savings at 68. So whether he can retire or not, he retires. Okay. Now, how much do you think the second brother has? The one that saved a little bit every month. He just earned a small amount more and saved it rather than spent it. Well, the second brother will have just over 6.8 million pounds in savings. It is ridiculous.
Wow. Okay, Adam, firstly, I'm 41. Why did I not do this at birth?
Yeah, true.
You know?
But this is why people say start saving early. They really go into the pension. Start your pension early. Start your pension early
Because you
because
can start a pension for your kids straight away. Like you can start these things. You can just put money away. If you were to put £1.50, was it £1? Did he invest? What did he invest every month? What was the amount he invested?
Uh,
Because
well,
he,
every well, it's about £1.43 an hour, but I think it worked out to be about £50 a week. So it was about,
yeah.
it's about 200 and a bit, £100,
So
200,
£50 a
£100.
week. So it's about 200 to £250 a month put away. Yeah, that is profound, isn't it? So even if you were to, think that where are you in your journey right now? You're 30 and you want to stop at 50, the impact that just putting £200 a month or £250 a month away is going to have a profound compound impact. Because the way that compound works is that you put your £100 in and you make 10%, straight away your £100 becomes £110. Then that bit is already in the market. So when you earn another 10%, you don't just earn another £10, you earn 111, you earn £11, right? So your interest or your returns keep going up. And even when there's volatility and fluctuations, that volatility and fluctuations rides and you keep building and building and building wealth over time. The power of compound is profound. It means that you get exponential growth. It means your money starts working for you. As soon as you put money into the stock market, it's working for you, not against you. If it's in a bank account, sadly, banks are investors at the end of the day. So they're onward investing. They're never going to want to pay you more than the stock market because they are kind of the in-betweeny bits. So I always think about the balance. A bank is not going to necessarily pay you more interest than they can make as an investment. So, and when you look at inflation, usually you'd expect from a real perspective to earn less money in banks. So, this is why the risks of investing are so deeply misunderstood. And that example is perfect. Hey, that is the title of the first show. Why the Rich Get Richer with Adam Brewer, right? That's the title of the first show because this is why we need to inspire people to come and learn and hear about investing, and just putting into something as simple as a global index tracker. Now we can talk about some of this jargon in future episodes. We can talk about some of these things come into into the Star Investment Circle. We can talk to you more about that. But fundamentally, what a really brilliant kind of example to demonstrate just that difference. One difference is obviously the one of the twins gave up a little bit more time at that early stage, a little bit more time, got up an hour early to get a little bit more money. Because if you want to invest, you have to have space to invest. Because if you spend everything you've got, you haven't got any disposable income, right? You need to have that. You need to have that space to invest in. How do you create space when, this is what I get asked a lot. How do you create space, if you're wanting to have capacity for loss and you're feeling like life is really hard? How can you help someone to create that space?
I think the first thing is the education, without a doubt. And we talk about, so we can talk about your ability to take risk and your attitude to risk, or your willingness to take risk and your objectives. And those three things fit together to give you the, I'd say, answer of how much you should invest, and when, and for how long, and in what assets as well. So it really all comes together. But what I would say is, and I'm gonna go. I'll come back to that. About 10 years ago, a company asked me to write an article, and one of the questions was, what is the biggest risk to investors over the next year? And my answer was the investors. And it's and they said I couldn't publish it, I couldn't write it, I couldn't say the biggest risk to investors are the investors themselves. But it is absolutely true that I see the biggest determinant between people who do well and people who don't is that behavioral part, those mistakes that people can make. And it's, some people are wired well and some people aren't, and that's not a good and a bad thing. That's not, better or worse. That's just how people are. um, but it's those mistakes that mean they get, these words are emotive, but greedy when the market's high, and they get fearful when the market's low, and it produces it means they make the wrong decisions at the wrong time. That is a real big determinant. So going back to those three things, if you can get that right, and and going back to what you said as well, Emma, is that if you can just invest a small amount that you want to, that it's not a huge proportion. If things go wrong for you, it doesn't mean you're going to have to sell the farm. You know, but you just do a little bit to get that education, and if you monitor it here and there and the other, every year, month, day, minute, and you see it going up and you see it going down, and just remember how you feel about that. How do you feel when it goes down? How do you feel when it goes up? And to be fair, everyone knows that if it goes up by if it goes up by a pound, you'll get 1 unit of happiness. If it goes down by 1 pound, you'll get 2.5 units of unhappiness. Okay, so you feel the pain more than you feel the joy. That is always the case. Um, but this education and this experience and knowledge you get from just investing early with a little bit of money, and you'll then start understanding the characteristics and nature of the market, what impacts it, what doesn't impact it, which is hugely important. And then it will put you in a better stead in future years to invest more, where you can make more pounds and pence, and you're not going to make those behavioral mistakes. So I think that's quite important to note.
Ah, Adam, I love that message. We're going to put a future feature. The future title is The Biggest Risk is You, right? The biggest risk to your investment is the investor. And the biggest thing that shakes the stock market is those negative vibrations, because greed is a negative vibration. It's completely, it's one of the lowest forms of vibration. And so if you're in a place of like, if you are like, buy high, sell low, you are vibrating at a quite an unhealthy frequency. And I would be saying you probably need to look at yourself really deeply, because these, and I can say this because this is coming from my wealth empowerment experience, right? And this has been me. I'm not going to lie. We are conditioned to be fearful and to be thinking that we need to be, you know, getting things at the best price, and going out there and getting a deal. We get rammed with Black Fridays, and it's everywhere. So by the way, this is nobody's fault. This is how we are conditioned by a very greedy society, probably as well. Not society itself, but like the people at the top. Let's be honest. But there's beliefs of then greed is when we buy, and then fear is when we sell. Both of those are really, really low energy, low vibrational emotions. And that then triggers the harsh reality of making a mistake as an investor. You're making a mistake for you, but often that is when we start seeing volatility in the markets. It's because people start to panic. People are short selling as well, trying to make money. They're trying to day trade. And I know that you have a big belief, and we talked about this, that this is a long game. These are companies we are invested. These are real companies that we are putting our money into, that we believe in, that we want to, invest in for the long term for good. This is why I believe, this is why it's a part of the segment, it's investing for good. We're investing for good for us because we're coming from a place of, rather than greed, like, let's go into it because we love the company. And then instead of being fearful when markets are thinking, seeing that as an opportunity to buy. Right? And we're switching the emotions to a much more healthy vibration, and it creates a sense of inner calm. It's what brings the markets back, I believe. Like, when there is that big volatility and big spike, that's because there's news that's come out. People jump on it. They start doing things to move the markets because it's new news. It's not priced in yet. The markets crash, then all of the people that are fearing it and selling. It drives it down. And then it's the people that bring in the equilibrium. Adam, people like you that are on the sidelines, on the paddleboard going, yeah, man, it's just calm. Let's just chill. Take the phone. I know it's bad. I know you're scared. Listen to me when I'm telling you now is not the time to sell. You are that balance with your clients, and then you see the opportunity to go and buy for your clients, right? It is a great place to sit
Yeah,
on that paddleboard.
yeah, and that's, I think, one of those truths that people don't quite uh, get at the beginning. is that have you heard the phrase don't just stand there, do something, and you flip it around, it's like don't just do something, stand there. And
No,
a
I've
lot of
not heard of
people
that.
it's flipped around. A lot of people think that if you're taking action, that's a good thing. You should take action, action, action. And probably the best action you can take is no action, is sit on your hands. When things are very bad, sit on your hands, don't
Doing it
do
now.
anything.
And it does
Just
make you
leave
feel
it.
different. Sit on your hands and you feel like you can't do anything. And that is a really great, when you're feeling panicked, that's a practice I might have to start doing in sauna. Do you know what you just reminded me of? I had a brilliant, beautiful interview with a founder of a sauna, Victoria Maddox. Her show's going out after yours, actually. And Finnish diplomats, Finnish diplomats do all of their diplomatic meetings in sauna because they go into a higher state of consciousness and they make better decisions. They're not making decisions in a crisis.
Sounds great. Sounds great. I'd like that.
They got a great sauna at Saunton. I'll take you anytime, Bibs. We can go there.
Lovely.
Honestly, it is game changing. And yeah, like you think, what was the saying again? The saying, the one that you just said, it was, oh, I need
Oh,
to write
oh,
it down.
yeah. Don't just do something, stand there. and
I love
and it
that.
really people think if you're making changes, you're making something better, and normally that's not the case, and not in investing anyway. Sometimes it's just think about it, let the information flow in, reassess, and then you'll probably reassess and say we're okay where we are. And taking back to your point, Emma, that says that what are we actually investing in? And this is a time, I'm jumping around a bit, but this is a time thing as well, because if you have the time to invest directly into companies, fine. If you don't have the time, it's hard to do. And maybe an index tracker or a collective fund will be better. And we can talk about that separate time, because that goes into quite a lot of detail about what we should do. But what you noted, investing is reality. We just think about, as you walk around, the first step is to walk around in your daily life and see, you go to M&S and you go, right, I can buy those shares. I shop in, you shop in Tesco's. You've got an Apple phone. I order things on Amazon. These are all companies that can be invested in. Um, and so it,
Whether
it's
we
it
would
is
or not is
everywhere.
to be questioned, because then we can go deeper into whether we like those companies. Because, and this
That's
is
it.
one thing, before we go on to that, how you invest, the companies you choose to put your money into is a really powerful thing. And
Yeah.
we'll come on to this in a future. We'll dive deep into this, I think, in a future conversation. But, whether you buy Amazon or Apple, two A shares, just got the letter A, I would never put my money in Amazon. No, I can't, because I know too much, right? And I just wouldn't hold directly. I do have trackers, like, and I do have funds, so I'm not saying that I don't hold Amazon, but when your wealth builds, your investment becomes a really powerful message. I feel like it's a beautiful way to vote, voting with your money, right? Because it's so hard for us to vote with the government and get the government to do what we want them to do. Investing gives you so much power, right?
Yeah. And you should, as much as you can, exercise your right to vote at AGMs for companies, and the
Yeah.
way that you want to vote. You can vote against management, you can vote for management, you can um there's a lot of different things you can do, and you should use that right. It's
Yeah.
quite hard and time consuming, but you should do it. Um and going into these companies, and I think that a good stage to get to is where you're in the shower and you're washing your hair, and you got Tresemme or something, and you look on the back and just say, who is it made by? You've got your mayonnaise out, you've got your Marmite out, you've got a Magnum. You don't realize that a Magnum is owned by the same company as Marmite. a Unilever, and you've got all these things, and just take a look to see what you're doing. What products are you buying? How are you living your life? And you can look at the back and say, actually, I really like that company. I'll look into it in more detail. And how do I like that company? Do I like what they're doing? Do I like what they stand for? And you've got to, and I know Emma, you're an advocate of this. You've got to sort of wade through a lot of the as you say, greenwashing and lip service to these things, and actually how they impact the world, because everything is a when we're getting into this ethical investing, environmentally and sustainable, responsible investing, and which we won't go into a lot of detail now, but you there's always two sides of a story. There's always one lever that is great and one lever that isn't, and you'll go this way. Some people want to invest, for example, you talked about SDGs, sustainable development goals.
Okay, thank
um,
you. I know what they are. It's the 17 UN Sustainable Development Goals, SDGs. It's just this is what is bamboozling, is using these initialisms. And even me that's in it, I was like, I can't remember what that is. Thank you. Thank you.
and yeah, and that's that's us trying to keep a job. um, I think so. If you look at those, there's 17, and they're like, so like no poverty. I've got them up here. There's zero hunger. There's quite good ones. Climate action, life below water, things like that, and it really puts some reality around it. Now, so let's say I want to invest with gender equality. Well, what scores highly on gender equality? BAE Systems, which is an arms communication company, defense company, as you say. So some people dislike them, some people love them, but they score really high on gender equality. So where do your not loyalties, that's too hard, but where do your views land, and where's the balance? Everything is a balance and a compromise. If you
Yeah.
really want that gender equality, you would go that way, but if you really don't like the arms and defense, you won't. And it's that kind of thing, looking into these companies to see where they score highly. And this is just a scoring.
Mm,
This is a gauge. Everything is a Any tool you use is a gauge for a conversation and to
mhm,
dig in further. But how it's always a compromise between things you like and things you don't like, and trying to put them together. And in the end, it also is, you've got to have your investment hat on as well to say, is this a good investment?
I think
Because you
that's
can,
it. What you've said, really, because I have worked with lots of different clients, and some clients would not want to have arms in their portfolio at all. They want to go and live in Costa Rica. By the way, the Costa Rica does not have an army. Some people believe that war should not exist, okay, and are so, I would say, you know, pro plants, pro everything, that they couldn't go into that. I had a client that didn't want to put money even into someone like a company like Tesco's, because Tesco's bought meat and sold meat, right? So the level that people can go to is really, really, really high. Some clients would say, I understand arms and defenses, but I don't want to, go into pornography. All of these things are preferences. And those 17 UN Sustainable Development Goals, each of them has a really big importance, right? So how, gender inequality, who's to say that that's more important than removing hunger? This nobody is in a position to say what is right or wrong, and often you can't have dark without light. What's really important is to build a portfolio, to build an investment that resonates with you, and that what you have. And when you're getting started, you're probably not going to be putting £25 a month into buying shares. You're probably going to go into buying a collective, a fund. And we can talk more about what that is in a future talk, but it's just a really simple way. And it's kind of taking that step back and going, okay, I really believe that getting started is the most important thing, and investing for good. You are going to be able to do more good if you have wealth. And getting started, it doesn't mean that you have to invest into terrible things, because there are collectives that generally give you the power to screen some of the things that you don't want to invest in as well. And I know you've got quite strong views on that. I think we should save some of those really strong views about impact investing and ESG and all of that for a future segue, because I think we can dive deeper into that. But fundamentally, when I'm thinking about investing, what's coming out of today's talk and what's really kind of come to the surface for me is just the feeling that I have is, the feelings that are rising in me is just the power that it gives us, the power that we have. It is how the rich get richer. Why the rich get richer? Because they start investing and start putting their money into meaningful assets that are going to enable them for their wealth to be not just growing by more, because therefore if you're trying to get more again, you're stepping into that greed vibration potentially, but to protect your wealth. Protection is as much about investing, and this is the irony. This is like the duality of investing. We think of it as risky because of the nature of ups and downsies. We talk about capacity for loss. You really only realize your loss if you're a forced seller at the wrong time, unless the company goes completely bust, right? So, when we're talking about that capacity for loss, and if it loses 50%, but then it bounces back because we know it's gone down 50%, not because the company's bad, but there's been a market event or whatever's driven that behavioural usually crisis in that moment, it bounces back. You're only a loser if you need that money because you haven't made provisions for normal life. If you're dripping money in, you shouldn't necessarily always need that 50%, because that £50 or a week, right? Because it's money that you would have otherwise been spending. And that's the beautiful thing of getting started, so that you're building up wealth over time and you're not having that attachment. And then you are building up that power into assets that ironically become a defensive strategy from inflation and from the cost of living. That's the duality of investing. There's risk in not investing, right? What's your take on all of that?
Yeah, I can't add. I can't add to that. Well, no, you summed it up very nicely. I think it is it's a mindset to know that you can do it,
Mhm.
because sometimes investing, if you said this before, that investing seems out of reach. It's so
Yeah.
much jargon. It seems so complicated, and there's also a misconception that I could lose all my money. That has happened to some people in the past, of course. But if you take a few simple steps, and be sensible about it and don't get too greedy, you can do. It's very hard to lose all your money. Okay, it
Mm.
is. You got to go out your way to make some huge mistakes to lose all your money. And the worst thing, and what I don't like to see, is when someone that's happened to someone in the past or lost a lot of money, they've taken it out at the bottom. Maybe they invested in one share, and you'll know this, from back in 2008, when a lot of people
Uh-huh.
worked for the banks and they had
Yeah.
all their pension in their bank shares, and they thought certain banks could never go bust or never go down. They had a huge amount of money in one share, and that share went down 90%.
And they
So they
also
lost all
then
their
had the
money.
defined benefit pension scheme in their company as well,
Yeah.
a lot of the
So
time, right? And this happened
yeah,
with some companies, big companies, and this is where they attach their nervousness to pensions as well. Pension, the tax wrapper. We're going to talk about that. I'm doing a little talk on tax wrappers on my YouTube channel on Thursday, to kind of bring some fun into tax wrapping, some wrapping maybe. Fundamentally, people get nervous about those things because they've had a bad experience. Because back in the day, you just used to work for one company your whole life. You'd then have maybe a defined benefit scheme, defined benefit meaning that it would pay your income in retirement, meaning the company was managing that risk. And then you also had all of its shares as like extra shares. And this is like an extreme example of all the things that could go wrong with putting all your eggs in one basket, putting all your eggs in one basket. And then you realize that company folds, you've lost your career, you've lost your maybe defined benefit pension scheme, and all the shares that you had have gone. I've known people, it's horrible to have sat back. I was at RBS when, maybe not to that level at RBS actually, but in '08, a lot of my friends that had had some, serious share save schemes when they got bailed out by the government, it was not great for them, and I felt it for them. I didn't have that. I came into trading when all of those perks didn't exist. Hence why I'm, still working hard in North Devon, because, I didn't get to experience the highs, but equally, I did not experience those lows either. And I really saw and experienced the harsh reality of eggs in one basket. Which leads me to a really beautiful word that we talk about, another jargon of diversification. The biggest thing when you can get started is and it goes back to your three things. If you go back to the start of how we started this conversation, there's three things of why, and then capacity for loss and attitude to risk. If you have different pots, you set up your house pot, so you have a lifetime ISA. Then you set up your pension as well alongside it. You could put £25 a week into your lifetime ISA, £25 a week into your pension, and then some into your stocks and shares ISA, even a bit into a general investment account. We can talk about what all of these things are, but fundamentally, you're spreading things around. You don't have to put all your eggs in one basket. You can have funds in each one. Each fund could have hundreds of stocks and shares within it. It's a diversification just means that you're spreading that risk. You then have a business that's in a different place to the company you invest in. You might then have your home, a property. This to me is how the rich get richer, because they do spread their money around. They don't just own one asset. They are creative, and that is how they end up being in Necker Island on the paddleboard or wherever, right?
Well, that's the it depends what we define as rich, isn't it? I mean, because I think in terms of the rich of how uh, the average person gets richer or rich is, yeah, diversification. But actually, I would put one caveat in that. If you look through the richest 500 people in the world, they all had they had their eggs in one basket.
And that was probably their
um,
entrepreneurship,
and
right?
they and that was the entrepreneur
And that
in
is
their
why, though,
company, and that's it.
you are
So
so,
yeah,
Adam, thank you for saying that, because I really do believe the biggest pillar, behind the whole Wealth Rebel show is the founders, is the entrepreneurship. I really
yeah.
believe in leveraging your power to create wealth. Because in order, and comes back to, do when I asked you at the start, how do you create space to invest? You need to create wealth to begin with. And I really believe that is through entrepreneurship. So totally on board with that, because I think that when you look at the highest, this is why you come into my world, Adam. You just sprinkle this magic, and I'm like, you remind me of why it all fits together. There's not just one piece of the puzzle that we're working on, because we have to create the wealth to then go, okay, so we're creating it here in what we love. Your ikigai. And I talk about my ikigais. You create it, and then that's when you find the space to put bits over into pensions, ISAs, to make more of it and to protect it and have greater good and greater impact. Love it. Ah, I love it. Adam, we said we'd keep it to 45 minutes. I think we've gone over, but I just really want to finish by um just kind of bringing it back to you, really. Like, if you have just got one little piece of wisdom or nugget to leave everyone with today, what would that little bit of wisdom be?
The 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 biggest thing that someone can do, I think, if they're just starting off into investing, is firstly just do it, small amounts. Um, and the second thing is probably, and this goes for a lot of people, don't look at it. Leave it alone. Nothing good comes from looking for something every day or every week or every month, probably every quarter. Know what you're investing in, invest bits into that, and look once a 6 months, maybe once a year. And it does depend on what you're investing in, but the general collectives indexes, just don't look. It doesn't give you any joy to look. Even if your money's going up, by the way, it won't give you any joy.
That's not what it's
That's
about, is
maybe a
it?
negative
Who
point
gets,
to end
no,
on,
no, it's not a
but it
negative
will
point.
help people. It will help
This is
people a
why
lot.
people are on the paddock. Get out in life, find your pleasure through your entrepreneurship, find your pleasure through life, and leave your money just working for you. Really simple. Keep it simple. Keep it simple, and just don't look at it. Don't stress the nuts. Don't get dragged into the news. Sit on your paddleboard. When you hear someone down the pub going, "Oh my God, this is happening, this is happening," sit on your hands. Be that person to sit on your hands and
Yeah.
sit back. You've shared some amazing nuggets today. Thank you so much, my love, for coming on and starting this, and really helping us to keep moving that needle forwards of education, knowledge, lifting the lid on the jargon, really bringing some of those truths. I can't wait to carry this conversation on. I think there's some things that have really come up here today that we can kind of bring some of those topics forward. If anyone is listening to this on the podcast or on YouTube, don't forget, come into the Star Portal, hit the link in the show notes of the About section. You get 1 month free. Adam will be there in November. It's only £8 a month after 1 month free with code Star 1 month. Come in and